You want to learn to trade and you want an account big enough so that you can live your dream life from the proceeds of your trading profits. But there's one question in your head, and that is, how am I going to grow my account? In this video, I'm going to share with you the fastest way to get a big account, whether you're attracting investors, going for a funding challenge, or managing money for clients. If you do what I'm going to show you in this video, you'll have no problem growing your account very, very fast. And before you know it, you'll have a big enough account to live off of. So we're going to be going over 5 principles in this video, and after this video you'll have a really good idea and a real good insight into what you need to be thinking about in terms of setting this up as an attractive trading business for clients. We're going to be going through being ready, so knowing when you're ready to actually make that move and transitioning into taking your trading to the next level. We're going to be talking about how you can demonstrate performance so that your investors and clients have peace of mind knowing that they're investing their money with the right person. And then we're going to go over mutual partnerships, so the actual benefits to both parties to make it a mutual partnership to attract the highest quality investor that suits you and your ideal client. And then we're going to be going over the contract agreement, things that I think that you should have in place in the contract, and I've got a special gift for you there. And then we're going to be talking about reward performance, so how you should be charging your clients based on my personal preferences. Okay, so that's what we're going to be going over, and as you can see, you're going to get a real good insight into managing money and attracting clients. So let's get stuck in. So the first thing, before you even think about managing anyone's money or attracting any clients, you need to be ready yourself. And that includes being mentally ready, so you have full trust in your system. You need to have proven to yourself that you can be consistently profitable and have some decent returns. So you need to be mentally stable. If you've just had a bad incident in the family or a disaster, right, and something's happened that's made you feel a bit mentally on tilt, well, you're not in the best frame of mind to then go forward and start attracting clients or managing money. You need to be in a mentally sound place. You also need to be technically ready. So you need to be comfortable with the equipment that you've got to trade, and you need to know it in and out, because you're managing someone else's money. And when you manage someone else's money, they need to see that it's under professional control. Because it's one thing to just flip open a laptop and manage money, but it's another thing to manage other people's money and trade it as a business. So you want to consider having a decent setup. Make sure that you're technically ready. Make sure your internet connection is sound. Maybe get some reports from your internet supplier just to show that the download speed and the upload speed, and you've got those statistics at hand as well. So at this point, you really want to have been in the game a little while, and what you're doing is you're treating your trading like a business. So you want to have all of the money management results stored in a spreadsheet. We give this to our tier 1 trading guys from day one. You can see here, these are all real trades. These are real trades taken, logged, journaled, put into a spreadsheet. So all the stats are there. And in the trade log, you can see the trade log here. We can see the win-loss percentage, and you don't need to necessarily show this to the investor, but what they will like to see is a summarized version of this. So for instance, if we go to the live equity, the investor's going to want to see the trades that you've taken or the performance over the year or the period. So this isn't going to be a deal breaker, right? This isn't going to make them go and throw their money at you. But what this will do is it will show them that you're treating it like a business. You're journaling your trades. You've got a proven track record. So this isn't going to be the one thing that sort of makes them throw their money at you, but it's important. Now, what they might want to do is track you from here on out. So you might have a soft landings approach where you say, okay, for the first 2 to 3 months, you can track my progress from here on out just to show you that it's on track with my previous results and my projections. And then in 3 months' time, we can talk about transactions and managing money. So you want to have something like this in place. Now, there's sites that you can go and display your results on, and the first one I'm going to show you is MyFXBook. MyFXBook is currently compatible with most platforms, and you can link your account to display all of your results. And in this platform, investors and people can come in here and track all of this. It's very transparent. And what you can see is, if we just go to these top charts here, for instance, you could see who's doing what style of trade, you know, different traders. And when you click on one of these traders, let's just go to Crazy Trader, you can actually click on these names here, and you're actually going to get all of their results. So you're going to get his progress, his performance, his track record, his gain, his drawdown in pips. So they can see your max drawdowns. That's very important. They're going to want to see max drawdown because that's the biggest loss historically that you've had before reaching new equity highs. And that's going to rely very heavily on the personality of the investor, whether or not they give you money. Some people like to see small, steady, incremental growth. Some investors like to have a little bit more because they've got a bit more of an appetite for risk, and they don't mind if it's a bit more volatile. They don't mind a bit more volatility in the equity curve. But you can track all of that stuff on here, and if you have your own account on here, then people can just come on here, or you can send it to your investors and they can come here and they can track it this way. There's another similar website called FX Stat. It's very, very similar, very nice website as well, but it's a similar thing. You can link your brokerage account to this. They've got web platforms as well that you can just actually trade on the platform itself, and it's all integrated into one. And again, many different brokers and platforms, and it's all able to integrate with each. So that's what I would suggest. Definitely you want to be treating your trading as a business. You want to have your own journaled trades, and importantly, so that they can see that you're transparent about your trading results and you're treating it as a business, etc. Now, the reason it's important is, one, you're very professional about your trading, and secondly, you can then open this up a bit more globally or a bit more socially with your results. Not only does that give investors peace of mind that you're being transparent globally, but you can also attract global investors. All right, that brings us on to sort of really attracting investors and the mutual partnerships that you're looking to set up. First of all, there's one way. Obviously, investors can be tracking your performance on those websites, FX Stat or MyFXBook, something like that. You might be connecting with them on social media. You might find potential investors on LinkedIn and places like that, but you might also attend networking events. There's absolutely billions of investment money that needs to be invested every year from many different investors across the world. There's just simply not enough good investments. There just aren't enough good businesses. So there are people looking to enhance their investment plan for the future, and there are people who are paid by big family offices or big investors to find good returns. So they're trying to give this money away and they just can't get rid of it. So if you attend business events, networking events, those places are riddled with people looking to throw their money at good investment opportunities. So as you're doing this and going to these events, you start to attract investors. They're going to have people contacting you, whether that's networking or through these websites, and looking to do deals with you. And this is really where you want to suss out your ideal client. And what I mean by that is the way you're going to need to approach this is to have a mutual benefit. And if anything, you want to sway the advantage towards the client, okay? What's in it for them? You know, really try and put their mind at rest and sort of mitigate any risk or have a backup or contingency plan for what they would expect you as the trader to have as a contingency plan for their hard-earned cash. The best way to do this is try and put yourself in the shoes of the investor. Try and think like them. When you go to attract this investor and you go and have a meeting with the investor, you want to be thinking as much as you can like them. Not what's in it for you, but what's in it for them. And if you can just concentrate on that in that order, you'll have a very mutual partnership. And the reason I say err on the side of their interest is because every investor is going to give you their money in the opportunity for an upside in their investment. They're not looking at a downside. They're just looking for an upside. But equally important to them is the loss of their money, all right? They want to see that their asset, their money, is protected by you, protected from harm, and they want to stop their money from just evaporating into thin air. So there's a number of risks that all investors are concerned about, whether they ask you or not. They generally have tons of questions buzzing around their head. And the first one is, what if their system stops performing? What if you run off with their money? What if there's a dispute? What is your position size? How do you manage certain risk situations? And without going into interfering with your system, because essentially they're investing their money in you as the trader and your ability to use good judgment and discipline and consistency in the market. So they're not going to interfere, but those are the questions that will be buzzing around their head, and they'll want you to be able to answer those questions and have an answer for those questions or a contingency plan in place for those questions. Because think like them. Remember, they're handing over their money. They're going to want to know how you handle certain situations. So I'd always say err on their advantage. Make sure the agreement and the meeting that takes place is very, very heavily in their favor, so that there's less of a question over the performance fees later on down the line. And we'll go through that in just a bit, but just before we finish on this section, one other thing to bear in mind is as you're going out to attract investors and you start having meetings with them, when you're showing them your performance and you're answering all of the questions that they might have and demonstrating how professional you are as a professional trader, explain to them that you won't be managing their money just as you're about to experience a drawdown. And what I mean by that is, although there's no way of telling when you're actually going to hit a drawdown, it's always a good idea not to start managing money at the end of a big winning streak. And I'm sure you can guess why. Because obviously, for any big winning streak, we expect a bit of a drawdown or a bit of sideways movement. So it's not going to be good for your mental psychology as you've just taken on a new investor and you're on a hot streak and you're not on a hot streak anymore. It might knock your confidence a bit more than usual. But secondly, you're going to want to be professional. So you want to manage money just how you would like to manage your own money. So just as we've come through a drawdown, those are usually the best times. If you've been in a drawdown for an average period of time based on your historical journal, well, then you want to allow that amount of time. For instance, if it's particularly bad, your system's bad in the summer or doesn't perform well in the summer, wait till the end of the summer before you start agreeing to manage money and explain that. Be open to the investor and explain that to them. What you don't want to do is hit a winning streak, agree to manage some money from your investor, it gives you £250,000, and then you know that you're going straight into a drawdown. And all that's going to do is put pressure on both parties. So try and avoid that. Try and keep mentally stable as much as you can. You want to be as psychologically strong as possible. So use your common sense on that, right? All right, that brings us on to the contract agreement itself. A contract agreement is something that should be drawn up no matter who you are managing money for. It's an absolute essential. You must have a contract in place so that it gives peace of mind to both parties during the agreement. So I'm going to run over some of the things that you may or may not have thought of to include in your contract agreement. And the first thing to think about is going to be thinking about it from their point of view, right? Obviously, we've been over this already, but when you have meetings and you're attracting investors, you want to attract the ideal client. So you want someone who's got realistic expectations. You want to draw up the entire contract from their point of view. And then you can think about the fair exchange from the performance side, which we'll go into at the end of this video. But you want to think about it from their point of view. You want to state the markets clearly, okay? So what you'll be trading. You don't have to tell them every single currency pair, but if it's foreign exchange, put foreign exchange. If you're adding in any types of futures, options, indices, whatever it is, just state in the contract so that they know where their money is being placed. That's fair. The next thing is an important one, is stipulate who owns the account. So there's different ways of opening an account. If you're just attracting one investor, well, it might make sense for them to open the account and control the account, and they can set it up as a joint account. And this just makes them feel like they've got access to the account at all times, and they essentially put the money in, do the deposits. You can't withdraw any of the money, and they can just monitor the performance. And then what happens is you invoice them at the end of each period for your performance, but you can't physically withdraw the money from that account. That gives them a bit of peace of mind and control rather than their money just being in one of your accounts. Now, if you're going to go out to attract multiple investors, which I think most people do, then you might want to have all of the money in one account to sort of propel and accelerate the growth of your account. That's one of the benefits of doing that. But that's something to bear in mind. So just have something in the contract that says who opens the account. Is the money transferred to you and you run it in your account, or do they open an account and give you the username and the password, etc.? And then you can control it as a joint account. Okay, so the next thing is the trading strategy and the losses. Have something in the contract on how you manage losses and what the realistic drawdown is likely to be, the max drawdown based on your performance, so that they've got that mentally prepared in their mind. Because if you take an abnormal loss, you want to have something in the contract to say, for instance, if the account balance drops below 50%, say, you have to stop trading immediately and they're able to withdraw the funds. Now, the next thing is absolutely essential. No interference. Have something that stipulates in the contract that they are not to interfere at all. I know of traders who have managed money and they've done very, very well, very steady growth, and then the investors get excited. They ask them to increase the position size, and then what this does is it goes away from the trader's strategy. It makes them emotionally unstable, and when they start to hit a drawdown, they take bigger losses, bigger drawdowns, and this can cause all sorts of obvious problems. So just tell them absolutely no interference. They've invested their money in you because of your good judgment and your ability to be disciplined and consistent in the markets. So that's the way it should be. There should be no interference from their side, otherwise they'd be trading their own money if they were so good at it. So no interference at all. The next thing is a withdrawal notice. So as you're trading their money, have something that says you cannot withdraw within 24 hours without giving notice, for instance. So you want to know if they're going to be withdrawing money because you're about to increase a position size based on the account size, or maybe you're getting your risk based on the account size, a percentage of the account size. If they're just going to go and withdraw without telling you, that could really damage your results as well. The next thing is to also state other clients. So let them know that it's your intention to manage other people's money as well. Let them know that they're not going to be the only one. Let them know that you might use your strategies on other people's investment money as well, and that you're going to be managing multiple accounts. It will just make it easier in the long run if there's something that comes up in the future and they say, well, you know, where was your focus? And you say, well, I was managing this person's money or this person's money as well. They can definitely get a bit funny about that, so just make sure that you're upfront about it if you intend to manage other people's money. The next thing is a termination notice and a call-off period. So when you're coming to the end of your agreement, or if they decide that they want to withdraw their liquidity, then you need to just have a sort of call-off period so that they can't just take the money out straight away. You might be in a trade, you might be watching a trade that's about to complete, so you want to have a call-off period that says something like, if you want to end the contract, we need a 15 to 30 day notice, something like that. 2-week notice. Now, you can have this template, this download, but I recommend that you get a lawyer to look over the contract, maybe employ a lawyer to write the contract of your own, but you certainly want to have one, look over it, approve everything, and make sure that it's all legitimate and you haven't missed anything for you or the other interest. Remember, it's not just you, this is a partnership, so you want to look out from both perspectives, and you want to make sure that you haven't missed anything. And then you want to have a signature section on the contract and a witness signature. You don't have to have a witness signature, but I recommend it because when they sign it, you want to make sure that they sign it in a mentally stable condition. So it just gives you that extra peace of mind that they haven't just chucked a load of money at you in the hope for some unicorn, and one of their closest friends or relatives or whoever has witnessed their signature has been there and said, yep, this guy or girl knows what they're doing and they're happy for you to manage their money. And finally, on that point, I want to say family is no different. Okay. I know some people who say, oh yeah, I'll go out and I'll manage your money for friends or family. And at the end of the day, if you take all of these things into account that I've been over already, if there's any discrepancy between any of it, it would make no difference if it's family or friends or professional investors. It'll all be the same chaos. So make sure that you treat your friends and family the same way as you would any investor. I see this so many times where there's friction in families because something wasn't drawn up in the first place and both parties weren't aware of the actual rules and the contract agreement. So make sure that you get that in place. All right, and then finally, the best bit. This brings us on to the reward on performance. How to charge. So fees and charges. And there's many different ways that I see people do this. Some charge upfront fees just for the transaction costs. So an initial upfront fee. Some people charge monthly managing fees, and that's common for most investment funds. They usually charge an annual fee. But I personally, and you don't have to go with this, but I would personally recommend charging a performance fee based on the actual trading account. So if there's not an increase in the investment account, then you don't profit either. It's like a no-win, no-fee type arrangement. But you'll find that if you angle it that way, you can charge a lot higher performance fee. I know people that charge anything from 25 to 50% for the performance, but essentially what you're saying to the investor is, if I don't increase your investment, then I don't get paid either. And it really, really gives them a good peace of mind knowing that they're with someone who's got their best interest at heart. And then what you do is you retain a performance fee. Let's just say 25% on the share of profits earned on the investment, subject to a high watermark. And I'm going to explain what high watermark is right now.
So the high watermark means that you'll only receive a performance fee when the value of your investment is greater than the previous greatest value. So if the value of the investment drops in value, then you will only receive a performance fee again once the value of the investment has gone above its highest reached value or its highest watermark. So I'll give you an example of how that works. Let's just say in January you get an investment of 100,000, okay, 100,000 pounds or dollars, and you have a good month, and in February the investment has increased to 105,000. You've now got a value of 105,000 in the account, there's 5,000 profit, and the performance fee would be 25% of that 5,000 pounds, so 1,250 pounds. So you take the performance fee, you've set the high water mark of 105,000, and the closing balance minus your performance fee, which you invoice to the client, will be 103,750 pounds. Alright, so you've had a winning month. Now let's just say in March, the investment is decreased to 103,000 because you've had a loss of 750 pounds. The performance fee in this case would be zero because the closing balance is £103, and you can see that the high watermark that we've left here hasn't been broken. So let's take it a step further then and say that the next month in April you have a winning month and the investment is increased to 104,750, so below the 105, but you still haven't quite reached the high watermark, which means that the investment's increased to 104,750. The profit is 1,750, but because you haven't breached the high watermark, the previous high watermark, then your performance fee is still going to be zero. So there's no performance fee charge because the high watermark of 105,000 previously hasn't been reached. And because that's the highest value that your investment has reached, you don't charge any performance fees. Okay, so then let's say the following month in May, you take the investment up to 107,000, which means the investment is increased to 107,000, the profit is 2,250, so then you take the performance fee, which is 25% of the 2,000, which is £500. So hopefully that makes sense. Now, there's going to be times where the investor wants you to leave the money in the account for compounding growth, and they may want to pay you out of their personal funds or another account. So make sure that you check with them when you're invoicing them for the performance fee, where you invoice that. They may want to take it out of this account, or they may want to pay you from another personal account. So you want to make sure that you've got all that covered as well. Just to give you some perspective or an idea of numbers, if you manage to go out and get 2 investors with $500,000 each, or 4 investors with $250,000, something like that, and you manage to accumulate £1 million, which is pretty easy to do once you can demonstrate a performance like this. Say you're doing 3% a month on average, well then 25% of that 3% is going to be £7,500, so you're looking at around £7,500 or around $9,000 per month for a performance fee. And I know traders who have come through and they're doing very well. They've gone out and managed money. They've accumulated £1.5 to £2 million. They're doing anything from £16,000 to £20,000 per month on average. So hopefully that gives you an understanding and a real good insight into how to go and attract investors, how to manage money. I would say get out there and network once you're ready. You won't have a problem finding them. I would say try and find your ideal client. There's no need to go and take money from lots and lots of different people. It needs to be a mutual agreement. You want to find someone who's got the right appetite for risk, someone who's got the realistic expectations. Remember, you got to where you are because of all the back testing you did to put you on that that give you that mental stability and be comfortable with losses. You want to find someone who understands that and appreciates that. There's real no need to sort of go out and attract everyone. You just need a couple, 2, 3 max investors to really do well out of managing money.
So hopefully that gives you a good understanding and a real good insight into how about attracting investors, how to manage money. I would say get out there and network, and once you're ready, once you put all this in place, you won't have a problem finding them, because you'll have a new confidence in your trading. So you can go out and you can find your ideal client. There's no need to go and take lots and lots of money from lots of different people. It needs to be a mutual agreement with who you do get investment from. You want to find people who have the right appetite for risk for your strategy, someone who's got realistic expectations. Remember, you got to where you are because of all of the back testing that you did to give you that mental stability and be comfortable with taking losses. You want to find someone who understands that and appreciates that. There's no need to go and attract everyone and people who don't understand that. It's just a headache. Then you just need 1, 2, maybe 3 investors to really do well out of managing money. So as I said, go and download the contract template. This is my one. If you've got any questions about this, please leave them in the comments and I'll do a further video explaining so that I can help you go and grow an account as big as it can possibly be. But really, the last message is it all boils down to you proving it to yourself. You're never going to attract investors if you can't prove to yourself that you can do this. You owe it to yourself. Go and get good at it. Let me know if you're gonna go and get good at it. Type in the comments, I'm gonna do this, and keep me updated with your progress. I'll see you in the next one.